Today, we're diving into one of the most important investment books ever written, The Intelligent Investor by Benjamin Graham. Known as the father of value investing and the mentor to Warren Buffett, Graham's timeless principles have guided generations of investors through both bull and bear markets. In this video, we'll break down the key lessons from the book, chapter by chapter, showing you how to think like an intelligent investor, avoid costly mistakes, and build wealth with discipline and patience. Whether you're new to investing or looking to sharpen your strategy, this summary will give you insights that can transform the way you approach money and markets. So grab your notebook, because by the end of this video, you'll understand the single most powerful concept in all of investing, the margin of safety. Preface by Warren Buffett. When Warren Buffett speaks about investing, the world listens. And in the preface to The Intelligent Investor, Buffett does not mince words. He calls Benjamin Graham's work by far the best book on investing ever written. For Buffett, this book was not just a guide, it was a turning point. He first read The Intelligent Investor when he was only 19 years old, and it changed the way he viewed the stock market forever. Instead of seeing stocks as mere pieces of paper that went up and down in price, Graham taught him to see them as pieces of real businesses. Businesses with assets, profits, and futures. Buffett explains that Graham introduced two powerful concepts that would become the foundation of his own investment philosophy. The first is the idea of Mr. Market, the imaginary character who shows up every day, offering to buy or sell stocks at different prices. Sometimes Mr. Market is wildly optimistic, sometimes he is deeply depressed, but Graham's lesson is clear: the intelligent investor does not follow Mr. Market's moods. Instead, he takes advantage of them. The second, and perhaps most important, is the principle of the margin of safety. Buffett reminds us that investing is never about certainty. The future is always unknown. But if you buy securities with a wide margin of safety, meaning they are priced well below their true value, you protect yourself against both your own mistakes and the unpredictable turns of the market. Buffett emphasizes that while markets and technology change, human nature does not. Investors still get carried away by greed in booms and paralyzed by fear in busts. This is why Graham's timeless wisdom continues to matter today, decades after the book was first published. He also points out that Graham never promised easy riches. Instead, he offered a framework for disciplined, rational investing. Buffett himself admits that without Graham's influence, he would not have become the investor, or the person, he is today. In closing, Buffett urges every reader to take this book seriously, to study it carefully, and above all, to practice its principles with patience. Because, as he puts it, those who truly absorb Graham's lessons will never again be at the mercy of market madness. They will stand apart, guided not by speculation, but by intelligence. Introduction. Benjamin Graham opens his masterpiece with a simple but powerful message: this book is not about how to get rich quickly. It is about how to become a truly intelligent investor, someone who approaches the market with patience, discipline, and a sound framework for making decisions. He makes an important distinction right away. There are two types of investors he is writing for. The first is the defensive investor, someone who wants safety, reliability, and freedom from constant worry. This type of investor is not looking for thrills, but for steady results. The second is the enterprising investor, more active, more willing to put in the time and effort, seeking slightly higher returns through careful research and selection. Graham assures us that either path can lead to success, as long as it is pursued intelligently. What Graham warns against, however, is speculation disguised as investing. He explains that the biggest danger in the financial markets is not ignorance, but emotion, allowing greed during market booms and fear during market crashes to cloud our judgment. The intelligent investor must resist this. Instead of being swayed by the crowd, he must ground his decisions in logic, facts, and discipline. One of Graham's central points in the introduction is that investing is most intelligent when it is most businesslike. That means seeing a stock not as a lottery ticket, but as part ownership of a real company, with real assets and earnings. The goal is not to outsmart the market every day, but to build long-term wealth while protecting yourself from unnecessary risk. He also reminds us that even the best investors will make mistakes. Losses are inevitable. But the intelligent investor minimizes those mistakes through diversification, careful analysis, and above all, the principle of the margin of safety, buying securities at prices low enough to allow for errors in judgment or unexpected setbacks. In this introduction, Graham sets the stage for everything that follows. He does not promise shortcuts or secrets. Instead, he offers a philosophy, a way of thinking, that can protect ordinary investors from the wild swings of the market and from their own worst impulses. And finally, he makes this clear: success in investing does not depend on brilliance, but on character. The true intelligent investor is not the one who knows the most, but the one who can remain rational, disciplined, and patient when others are losing their heads. Investing is not a game of luck or speculation, it is a lifelong discipline. With this foundation laid, Benjamin Graham now begins to explore the principles that make investing intelligent, starting with the very first question: what is the real difference between investment and speculation? Chapter 1: Investment versus Speculation, Results to be Expected by the Intelligent Investor. Benjamin Graham begins the book by asking one of the most important questions in all of finance: what exactly is the difference between investing and speculating? To many people, the stock market feels like a casino. Prices rise and fall daily, fortunes are made and lost, and it is tempting to think of buying shares as placing bets. But Graham draws a clear line between speculation and true investment. An investment, he says, is an operation that, after thorough analysis, promises safety of principal and an adequate return. Anything that does not meet those conditions is speculation. In other words, investing is grounded in careful study, protection of capital, and reasonable expectations. Speculation, on the other hand, is chasing after profits without a solid foundation, often driven by emotion or market excitement. Graham does not condemn speculation entirely. He admits that it can be thrilling, even profitable at times. But he warns that it should never be confused with intelligent investing. Speculation is like playing with fire, acceptable only if approached knowingly, cautiously, and with money you can afford to lose. The danger arises when people deceive themselves, believing they are investing when in reality they are speculating. He illustrates this with history. In the roaring 1920s, investors rushed into stocks at soaring prices, convinced that the boom would never end. But when the crash of 1929 came, millions lost their savings, not because they had invested wisely, but because they had speculated recklessly. Graham's point is timeless: markets will always fluctuate, sometimes wildly, and those who gamble will eventually pay the price. The intelligent investor, however, approaches the market differently. He does not expect miracles. He does not try to predict every twist and turn. Instead, he sets realistic goals. Graham explains that sound investing will not make you rich overnight, but it can steadily build wealth and protect you from catastrophic losses. He also makes a crucial observation: the results of investing depend as much on the investor's behavior as on the performance of the market. Two people can buy the same stock at the same time, one may prosper while the other suffers, because one treated it as an investment and the other as a speculation. At the end of this first chapter, Graham leaves us with a guiding principle. If you demand safety and steady returns, you are acting as an investor. If you chase after excitement, trends, and tips, you are speculating. And only one of these approaches, the intelligent one, can provide long-term success. Investment is not about excitement, it is about discipline, safety, and adequate return. With this foundation set, Graham moves forward to address a force every investor must confront sooner or later: the constant pressure of inflation. Chapter 2: The Investor and Inflation. In this chapter, Benjamin Graham turns to a challenge that affects every investor, no matter the era: inflation. Inflation, simply put, is the gradual rise in prices over time. It eats away at the purchasing power of money. $1 today will not buy as much a decade from now. For the intelligent investor, this reality cannot be ignored. Graham begins by reflecting on history. For long periods in the past, inflation was not a constant threat. In fact, there were stretches of time when prices actually fell. But in the 20th century, especially after World War II, inflation became a permanent feature of modern economies. Investors could no longer assume their money would hold its value if left idle. This raises a difficult question: how can an investor protect against inflation? Many people assume the answer is simple: own stocks. After all, companies own assets, earn profits, and often raise prices when costs rise. Shouldn't stocks automatically protect you from inflation? Graham's answer is more cautious. Yes, over the very long term, stocks have tended to outpace inflation. But in shorter periods, they can be highly unreliable. For example, stocks lost massive value during the Great Depression, and even in the 1970s, inflation outpaced stock returns for years. Another idea is bonds, fixed-income securities that pay steady interest. Yet here lies an even greater danger. Bonds provide fixed payments, but those payments shrink in real value when inflation rises. A bond yielding 5% may look attractive, but if inflation runs at 6%, the investor is actually losing purchasing power. So what should the intelligent investor do? Graham offers balance and realism. No single asset is a perfect shield against inflation. Stocks may help in the long run, but they can be painful in the short run. Bonds offer stability, but they are vulnerable when prices rise. Even holding cash is risky, as inflation silently erodes its worth. The solution, Graham argues, lies in diversification and discipline. Instead of betting everything on one type of investment, the intelligent investor spreads risk across both stocks and bonds. Neither is perfect, but together they provide balance. Stocks can capture long-term growth, while bonds can provide stability and income. He also stresses realistic expectations. The intelligent investor must never assume that any investment will perfectly protect against inflation. Instead, he should accept that inflation is a constant headwind, and plan accordingly. At the end of this chapter, Graham leaves us with a sobering but empowering thought: inflation is inevitable, but it is not fatal. With patience, discipline, and a balanced approach, the intelligent investor can protect wealth and even grow it, despite the slow erosion of money's value. Inflation is a permanent tax on your wealth, a silent force that never sleeps. The intelligent investor cannot eliminate it, but he can defend against it. With this in mind, Graham next turns to history itself, showing us how a century of stock market behavior can guide the investor's expectations. Chapter 3, A Century of Stock Market History, The Level of Stock Prices in Early 1972. Benjamin Graham now steps back and invites us to take a long look at the past. To understand the stock market, he argues, we must first understand its history, because while circumstances change, patterns of human behavior remain the same. This chapter begins with a sweeping review of 100 years of stock market performance, up to the early 1970s. Graham highlights how the market has gone through alternating cycles of boom and bust, often driven more by emotion than by logic. Prices rise far above the true value of businesses when optimism takes over, and they sink far below when fear dominates. For example, the roaring 1920s created a massive surge in stock prices, fueled by speculation and the belief that prosperity would never end. But when the crash of 1929 struck, optimism turned to despair, and stocks lost nearly 90% of their value. It took decades for the market to recover. This, Graham explains, is why no investor can ever afford to forget history. He also examines the more recent decades leading into the 1970s. After World War II, stocks delivered strong returns, and by the early 1950s many began to believe equities were the safest and surest path to wealth. By 1972, the Dow Jones Industrial Average had climbed to record highs, around 900 points. To some, this seemed to confirm that stocks could only go higher. But Graham warns that such optimism is dangerous. The key lesson here is this: stock prices are not the same as stock values. Prices swing dramatically, but the underlying value of a business moves far more steadily. When prices climb too far above value, risk becomes high, even if it doesn't feel that way at the time. And when prices sink too far below value, opportunity appears, even though fear makes it hard to act. Graham stresses that the intelligent investor must learn to view history with humility. The past shows us that markets are never predictable in the short run. But it also shows us that, in the long run, those who invest with discipline and patience are rewarded. Stocks, over decades, have produced higher returns than bonds or cash. Yet they have done so with periods of deep suffering along the way. He closes this chapter by cautioning against the illusion of permanence. Just because the market has risen for several years does not mean it will continue to rise. And just because it has fallen does not mean it will stay down forever. History teaches us that cycles are inevitable. The intelligent investor must prepare emotionally and financially for both booms and busts. The past century of market history reveals a simple truth: prices may dance wildly, but value moves steadily. The intelligent investor studies history not to predict the future, but to prepare for it. With history as our guide, Graham now turns to the most practical question of all: what general portfolio policy should the defensive investor follow? Chapter 4, General Portfolio Policy, the Defensive Investor. Now that Benjamin Graham has shown us the difference between investment and speculation, the threat of inflation, and a century of stock market history, he moves on to something every listener wants to know: what should my portfolio actually look like? In this chapter, Graham introduces the defensive investor, the type of person who wants safety, peace of mind, and freedom from constant monitoring of the market. The defensive investor values stability over excitement. For them, investing should not be thrilling, it should be dependable. So what does Graham recommend for this investor? His advice is surprisingly simple, yet profoundly wise: divide your money between stocks and bonds. He suggests a rule of balance. Never put more than 75% of your money in stocks, and never less than 25%. Likewise, never put more than 75% in bonds, and never less than 25%. In practice, this means a balanced approach, often a 50-50 split between stocks and bonds. Why? Because it provides protection against both extremes. If the stock market rises, you benefit from growth. If it crashes, your bonds act as an anchor, holding steady and reducing the pain. Graham emphasizes that this balance is not about chasing maximum returns. It is about controlling risk. The defensive investor is not trying to beat the market, but to survive it, calmly, rationally, and with confidence. He also warns against overconfidence. Many investors believe they can handle 100% in stocks because the market always goes up in the long run. But Graham reminds us that even long bull markets can end abruptly, leaving unprepared investors devastated. A defensive investor avoids this trap by holding bonds as a shield. Another point Graham makes is the importance of regular rebalancing. Suppose you start with a 50-50 portfolio. If stocks surge and suddenly make up 70% of your wealth, the intelligent defensive investor sells some stocks and buys bonds to restore balance. Likewise, if stocks crash and fall to 30%, the investor buys more stocks while they are cheap, returning to balance. This discipline prevents emotion from ruling decisions. Graham also addresses the temptation of new investment products, which promise high returns with low risk. He warns the defensive investor to stay away. If something sounds too good to be true, it usually is. Safety comes not from complexity, but from simplicity and discipline. Finally, Graham reassures the defensive investor that this approach does not require brilliance, inside information, or constant attention. It only requires character, the ability to stick to a simple plan even when others are swept away by fear or greed. For the defensive investor, success is not about beating the market, it is about staying safe, steady, and rational. By balancing stocks and bonds, and by maintaining discipline, the defensive investor builds a fortress of financial security. In the next chapter, Graham takes us deeper into this idea, exploring how the defensive investor should think about owning common stocks. Chapter 5, the defensive investor and common stocks. In the last chapter, Benjamin Graham explained the defensive investor's general policy of balancing stocks and bonds. Now, he turns to the question, what role should common stocks play in this balanced portfolio? For many defensive investors, stocks are intimidating. They fluctuate in price, sometimes violently. They bring excitement when they rise, and fear when they fall. Bonds, by comparison, feel safer, with their fixed interest payments. But Graham insists that common stocks are essential, even for the defensive investor. Why? Because while bonds protect your money in the short run, they are vulnerable to inflation. The income they provide stays the same, while the cost of living rises. Over decades, this means that bonds alone cannot preserve your wealth. Stocks, however, represent ownership in real businesses. Companies can raise prices, grow profits, and adapt to inflation. Over the long term, stocks have consistently outperformed bonds in preserving and growing purchasing power. But the defensive investor must approach stocks wisely. Graham lays out several key principles. 1. Diversify broadly. The defensive investor should never bet on just a handful of companies. Instead, spread investments widely, across industries, across sectors. This reduces the damage if one company falters. 2. Favor large, established companies. Stick with strong, financially sound businesses, leaders in their industries with long records of stability. These may not deliver spectacular gains, but they are far less likely to collapse. 3. Avoid speculative stocks. Defensive investors must steer clear of hot new issues, glamorous growth companies, or any stock promoted as the next big thing. These are often overpriced, and their risks are hidden beneath the excitement. 4. Consider index funds. Graham was ahead of his time here. He suggested that defensive investors who lack the time or skill to choose individual stocks should simply buy a low-cost fund that owns a broad market index. This provides automatic diversification and removes the temptation of speculation. 5. Set realistic expectations. Stocks can be rewarding, but not every year. There will be stretches of disappointing returns and even painful losses. The defensive investor must be prepared emotionally. Patience is as important as selection. Throughout this chapter, Graham emphasizes that stocks are not inherently risky. What makes them risky is the behavior of investors, overpaying during booms, panicking during busts, or expecting the impossible. The intelligent defensive investor resists these errors by staying diversified, disciplined, and humble. In the end, Graham assures us that common stocks are not the enemy of the cautious investor. Instead, they are a vital ally, as long as they are chosen wisely, held patiently, and viewed as part of a long-term plan rather than a short-term gamble. Common stocks are not a gamble. They are a shield against inflation and a path to steady growth. For the defensive investor, they are best approached with caution, balance, and patience. With this foundation set, Graham now shifts his attention to the enterprising investor, who is willing to put in more effort in search of higher returns. Chapter 6, Portfolio Policy for the Enterprising Investor, the Positive Side. In earlier chapters, Benjamin Graham outlined the path of the defensive investor, one who values safety, simplicity, and stability. Now, he turns to the second type of investor, the enterprising investor. The enterprising investor is willing to put in more time, effort, and study in exchange for the possibility of higher returns. Unlike the defensive investor, who follows a mostly passive approach, the enterprising investor actively searches for opportunities, situations where the market has mispriced a security. But Graham makes something clear at the very beginning: this is not easy. Enterprising investing requires patience, discipline, and a willingness to go against the crowd. It is not about chasing hot tips, trading constantly, or speculating on trends. It is about carefully seeking undervalued opportunities that others have overlooked. So, what positive strategies does Graham recommend for the enterprising investor? He identifies several. 1. Bargain issues. These are stocks that are selling so cheaply that their price is far below the true value of their assets or earnings. They may be unpopular, neglected, or temporarily troubled, but their margin of safety is wide. Buying these bargain stocks requires thorough analysis and courage to act when others are uninterested. 2. Relatively unpopular large companies. Sometimes, even big, established businesses fall out of favor. Their stock prices may decline sharply due to temporary difficulties or negative public sentiment. For the enterprising investor, these can be golden opportunities, strong companies available at bargain prices. 3. Special situations or workouts. These are unique opportunities that arise from mergers, reorganizations, liquidations, or other corporate events. They are more complex and often require experience and careful research, but they can yield attractive returns with relatively low risk if approached wisely. 4. Careful selection of growth stocks. While Graham warns against paying too much for glamorous growth companies, he does not dismiss growth investing entirely. The enterprising investor may include some growing businesses in his portfolio, provided they are purchased at reasonable valuations, not at the inflated prices the market often demands. 5. Switching between stocks and bonds. Unlike the defensive investor, who maintains a steady balance, the enterprising investor may adjust his stock and bond mix depending on market conditions. If stocks are excessively overpriced, he may lean more toward bonds. If they are undervalued, he may increase stock holdings. Throughout this chapter, Graham emphasizes that success for the enterprising investor comes not from brilliance, but from hard work, discipline, and rational thinking. The enterprising path is not for everyone, it demands time, research, and the ability to act independently of the crowd. But for those willing to put in the effort, it offers the chance to achieve returns higher than the defensive investor can expect, while still staying true to the principles of intelligent investing. The enterprising investor accepts that effort, study, and discipline are the price of higher rewards. But for every positive strategy, there are also dangerous traps. In the next chapter, Graham turns to the negative side, the pitfalls the enterprising investor must avoid at all costs. Chapter 7, Portfolio Policy for the Enterprising Investor, the Negative Side. In the last chapter, Benjamin Graham described the positive opportunities available to the enterprising investor. But now, he sounds a word of warning. For every smart strategy, there are also dangerous temptations, approaches that look promising but almost always end in disappointment. This chapter is dedicated to those pitfalls. The enterprising investor, eager to do better than average, will naturally be drawn to exciting prospects. But Graham insists, intelligence in investing is not about chasing excitement, it is about avoiding folly. So, what must the enterprising investor avoid? 1. Trading in the stock market. Many investors believe they can outsmart the market by buying low and selling high in rapid succession. They trade in and out, hoping to capture profits from short-term swings. Graham warns that this is speculation in disguise. History shows that frequent trading not only racks up costs but almost always leads to underperformance compared to a steady, disciplined strategy. 2. Buying hot, growth stocks. Every era has its darlings, companies praised as unstoppable, destined to dominate the future. But Graham cautions that these stocks are often priced far beyond their real value. By the time everyone is talking about them, their prices already reflect years of optimism. For the enterprising investor, buying such stocks at inflated levels is one of the most dangerous mistakes. 3. New issues and IPOs. Few temptations are stronger than the excitement of a new stock issue, especially initial public offerings, or IPOs. They come with fanfare, glowing stories, and promises of rapid growth. But Graham points out that most new issues are sold under conditions highly favorable to the seller, not the buyer. More often than not, IPOs are overpriced and underperform in the years that follow. The intelligent investor should approach them with great skepticism. 4. Easy money schemes. From time to time, Wall Street promotes exotic investments, complex funds, schemes, or guaranteed opportunities. Graham warns the enterprising investor that these almost always end badly. If something seems to offer high return with little risk, it is usually a trap. 5. Overtrading in bonds or hot debt issues. Just as stocks can be overhyped, so too can bonds, especially high-yield or junk bonds that promise extra income. These may look attractive, but they often carry hidden risks that can wipe out investors when times turn bad. The central message of this chapter is clear: the enterprising investor must learn the power of restraint. The temptation to speculate, to chase trends, or to believe in easy profits is constant. But the intelligent investor resists. Graham reminds us that true investing is rarely exciting. It is often dull, methodical, and patient. But it is precisely this discipline that produces lasting success, while those who chase excitement usually pay with heavy losses. For the enterprising investor, knowing what not to do is just as important as knowing what to do. By avoiding speculation, resisting glamour, and staying grounded in discipline, the intelligent investor protects himself from the traps that ensnare the crowd. With these cautions in place, Graham next turns to one of the greatest challenges all investors face: how to deal with the wild fluctuations of the market. Chapter 8: The Investor and Market Fluctuations. In this chapter, Benjamin Graham tackles one of the most unavoidable, and most dangerous, aspects of investing: the ups and downs of the stock market. For Graham, market fluctuations are not something to fear or to fight. They are a fact of life. Prices will rise, prices will fall, sometimes dramatically. What matters most is not what the market does, but how the investor responds. To explain this, Graham introduces one of his most enduring and powerful lessons: the parable of Mr. Market. Imagine, he says, that you own a business in partnership with a man named Mr. Market. Every day, Mr. Market comes to you and offers to either buy your share of the business or sell you his share, at whatever price he feels like that day. Sometimes he is optimistic and quotes a high price. Other times he is gloomy and quotes a very low one. The key is this: you don't have to act on his offer. You can simply ignore him, day after day, until the price he offers makes sense to you. This is exactly how an intelligent investor should treat the stock market. The market is there to serve you, not to guide you. When prices are foolishly high, you can sell. When prices are foolishly low, you can buy. And when prices are fair, you can do nothing at all. The danger comes when you let Mr. Market's moods control your own behavior. Graham emphasizes that the greatest enemy of the investor is not the market, it is himself. Fear and greed are far more destructive than any fluctuation in price. When stocks soar, investors feel euphoric and rush to buy at the worst possible moment. When stocks crash, they panic and sell at exactly the wrong time. The intelligent investor resists both impulses. Instead, Graham offers a better approach. For the defensive investor, market fluctuations are largely irrelevant. Simply hold a balanced portfolio, rebalance when necessary, and ignore the noise. For the enterprising investor, fluctuations are opportunities. When Mr. Market offers bargain prices, you buy. When he becomes overly enthusiastic, you sell. Perhaps the most important lesson in this chapter is this: price is what you pay, value is what you get. The market's daily price quotes do not determine the true value of a business. They are just opinions, often irrational ones. The intelligent investor focuses on value, not price, and uses market fluctuations to his advantage rather than being victimized by them. Graham closes this chapter with a timeless reminder: the intelligent investor is not concerned with predicting the market. He is concerned with being prepared, financially and emotionally, for whatever the market may do. The stock market is a pendulum, forever swinging between optimism and pessimism. The intelligent investor neither joins its madness nor fears its swings. He stands apart, calm and rational, using the market's moods to his own advantage. With this wisdom in mind, Graham now shifts to another critical subject: how investors should think about investment funds. Chapter 9: Investing in Investment Funds. In this chapter, Benjamin Graham turns his attention to a question that many ordinary investors face: should I invest in mutual funds or investment trusts instead of managing my own portfolio? On the surface, this seems like a simple solution. After all, investment funds are managed by professionals. They pool money from thousands of investors, spreading it across many different stocks and bonds. To the average person, this sounds safe, efficient, and easy. But Graham, ever the realist, urges us to think carefully. He points out that while investment funds can offer diversification and convenience, they also come with their own risks and limitations. First, let us consider the advantages. Investment funds save the small investor from the effort of selecting and managing individual securities. They provide instant diversification, reducing the impact of a single company's failure. Many funds have long histories, offering a track record to study. But Graham warns, do not assume that professional management guarantees superior results. The reality is that most funds, after expenses and fees, do not outperform the general market over the long run. In fact, many fall short. Why? Because fund managers are human too. They are subject to the same pressures of greed, fear, and herd mentality as everyone else. Many funds chase popular stocks at high prices, then sell in panic when markets decline. In this way, they often repeat the same mistakes that individual investors make, only with larger sums of money. Another problem is expenses. Management fees, sales charges, and hidden costs eat away at returns year after year. Graham reminds us that in investing, small percentages compound into very large sums over decades. What seems like a harmless fee today can cost you a fortune tomorrow. So, what should the intelligent investor do? Graham offers several principles. 1. Favor low-cost funds. Look for those with minimal expenses, ideally index funds that simply track the market instead of trying to beat it. 2. Do not chase performance. Just because a fund has done well in the past does not mean it will do well in the future. In fact, today's top performers are often tomorrow's disappointments. 3. Be skeptical of marketing promises. Fund companies are in the business of selling hope, not guarantees. Stick to facts, not advertisements. 4. For the defensive investor, mutual funds can be a reasonable choice, but only if selected with care, favoring broad diversification and low cost. 5. For the enterprising investor, direct ownership of individual securities may be more rewarding, since it allows him to take advantage of specific bargains that funds might overlook. Graham's central message is simple but profound: do not expect investment funds to make you rich. At best, they can help you match the market's average results, and that is not a bad outcome, provided costs are low and discipline is maintained. Investment funds, then, are like any other tool. In the hands of the intelligent investor, they can serve a useful purpose, providing convenience, balance, and broad exposure. But they are no magic formula, and they must be chosen with the same care as any other investment. With this lesson complete, Graham now takes us deeper, into the heart of his philosophy, with a chapter on the true essence of investing itself. Chapter 10, The Investor and His Advisors. In this chapter, Benjamin Graham asks a question that almost every investor struggles with at some point: should I seek professional advice? And if so, how much should I rely on it? The world of finance is full of advisors, stockbrokers, financial planners, money managers, and analysts. They often present themselves as experts who can guide you safely through the markets. But Graham cautions us, not all advice is created equal. Let's begin with the role of the stockbroker. Brokers are, first and foremost, salespeople. Their income depends on the commissions they earn when clients buy or sell securities. This means their natural incentive is not always aligned with your best interest. They may encourage frequent trading, chasing trends, or purchasing fashionable securities, all of which generate commissions, but not necessarily profits for the investor. Does this mean the intelligent investor should never listen to a broker? Not exactly. Graham tells us that brokers can provide useful information, especially when it comes to factual data, reports, company statements, and market prices. But when it comes to opinions or predictions about the future, the intelligent investor must tread carefully. Next, we consider financial analysts and advisors. These professionals may offer research and recommendations on companies and industries. Yet, as Graham reminds us, even the most skilled analysts are often wrong. Forecasting the future of markets, interest rates, or specific businesses is a nearly impossible task. The future is always uncertain. So, what role should advisors play? Graham answers with balance. For the defensive investor, an advisor can help set up a simple, disciplined program, choosing a sensible asset allocation, sticking to it, and avoiding impulsive mistakes. In this sense, the advisor's value is less about predicting the future and more about keeping the investor steady and rational. For the enterprising investor, advisors may serve as sources of ideas or perspectives. But Graham insists, the responsibility for decision-making should remain with the investor himself. No matter how expert the advisor may seem, you must never surrender your judgment entirely. There is also the question of ethics. Graham highlights the importance of dealing only with advisors who place their clients' interests above their own. Conflicts of interest are common in the financial industry. The intelligent investor must be alert to them, and always ask, who truly benefits from this recommendation, me, or the person giving it? Finally, Graham reminds us of a timeless truth: there are no shortcuts. No advisor, no matter how brilliant, can eliminate risk or guarantee superior returns. At best, a trustworthy advisor can help you avoid foolish behavior, maintain discipline, and apply sound principles. But the responsibility for being intelligent, calm, rational, and skeptical, still rests with you, the investor. In the end, advisors can be guides, but never substitutes. The intelligent investor listens, considers, and learns, but always makes the final judgment with independence of mind. For true success, you must accept that no one will ever care more about your money than you do. With this wisdom in hand, Graham now turns to a crucial distinction between investment and speculation, a line that every investor must understand clearly. Chapter 11, Security Analysis for the Lay Investor, General Approach. In this chapter, Benjamin Graham takes us into the world of security analysis, but he does so with reassurance. He reminds us, you don't have to be a professional analyst to apply intelligent principles to your investments. Even the ordinary investor, the lay investor, can learn to evaluate securities in a simple, rational way. So, what is security analysis? At its heart, it's the process of examining a company's financial position and prospects to judge whether its stock or bond is worth buying, holding, or selling. It's not about predicting the exact future price. Instead, it's about asking, am I paying a fair, or better yet, a bargain price, for the value I'm getting? Graham breaks down the approach. 1. For bonds and preferred stocks. Here, analysis focuses primarily on safety. The key question is, will this company be able to meet its fixed obligations, interest and principal, under reasonable future conditions? The intelligent investor looks at earnings stability, financial strength, and debt levels. Bonds and preferred stocks are not about big profits, they are about reliability. 2. For common stocks. The analysis shifts slightly. Stocks represent ownership, not just obligations. The investor must ask, is this company strong enough to withstand hard times? Does it earn consistent profits? Does it pay dividends responsibly? And, most importantly, am I buying its shares at a price that provides a margin of safety? Graham emphasizes the concept of the margin of safety once again. Even if your analysis is careful, the future is unpredictable. A margin of safety, buying below intrinsic value, gives you room for error. He also warns against two extremes. Overanalysis, where the investor drowns in details, building complex forecasts that look precise but rest on shaky assumptions. No analysis at all, where decisions are made purely on tips, trends, or emotions. The intelligent path lies in between, simple, disciplined, and fact-based analysis. Another key point, Graham urges the lay investor to be skeptical of predictions. Financial reports, forecasts, and expert opinions often look convincing, but the future rarely follows a straight line. Instead, the intelligent investor focuses on what can be measured, balance sheets, income statements, and past performance, while always allowing for uncertainty. Finally, Graham reminds us that analysis is not about brilliance, but about character. Patience, caution, and rationality are more valuable than flashy insights. Anyone can learn to ask the right questions. Is this company financially sound? Are its earnings consistent? Am I paying a sensible price? Answering these with honesty and discipline puts you far ahead of the speculator who relies on guesses and emotions. Security analysis, for the lay investor, is not a game of genius. It is a craft of common sense. By focusing on facts, demanding a margin of safety, and refusing to be swept away by predictions, you place yourself in the best possible position. The market may remain uncertain, but your principles will remain steady. With this foundation, Graham now moves into the deeper aspects of analysis, beginning with the study of the defensive investor's portfolio. Chapter 12, Things to Consider About Per-Share Earnings. In this chapter, Benjamin Graham focuses on a subject that dominates much of Wall Street conversation, earnings per share, or EPS. For many investors, earnings per share appear to be the ultimate measure of a company's success. But Graham warns us, what you see on the surface may not tell the whole truth. So, what exactly is per-share earnings? It's the company's net profit, divided by the number of shares outstanding. In simple terms, it's the portion of profits assigned to each share you own. At first glance, it seems like the perfect yardstick: the higher the earnings per share, the better the company. But Graham urges caution. He outlines several pitfalls that can mislead the intelligent investor. 1. Accounting choices can distort earnings. Companies prepare their financial reports using accounting methods that often allow flexibility, sometimes even creativity. By adjusting how they record expenses, depreciation, or reserves, managers can make earnings look smoother or more impressive than reality. Imagine a company that spreads out its losses over several years, instead of recognizing them all at once. On paper, its earnings look stronger, but the truth is less comforting. This is why Graham advises investors to treat reported earnings with skepticism. They are not facts carved in stone, but figures influenced by judgment and sometimes, self-interest. 2. 1 year of earnings means very little. Many investors fixate on a single year's earnings. Graham warns, that is dangerous. Businesses face ups and downs, booms, recessions, surprises. Looking at 1 year in isolation may give you a false impression. Instead, the intelligent investor should examine a long record, ideally, the past 7 to 10 years of earnings. Only then can you see whether profits are steady, erratic, or declining. 3. Growth in earnings is not always what it seems. When companies report rising EPS, it's tempting to assume strong growth. But sometimes this growth comes not from better business performance, but from things like stock buybacks, which reduce the number of shares, making each share's earnings look bigger. Temporary booms in the economy, which may not last. Or one-time gains, such as selling a piece of property or a division. The intelligent investor must ask, is this growth sustainable, or is it just cosmetic? 4. The importance of adjusted averages. Graham proposes a practical solution. Instead of looking at a single year, calculate an average of past earnings, smoothing out the highs and lows. This gives a far more reliable picture of a company's true earning power. This idea connects back to Graham's central philosophy: do not be swayed by the market's mood or by flashy numbers. Seek a realistic understanding of value, and demand a margin of safety. 5. Management's role in reporting earnings. Finally, Graham notes an uncomfortable truth: corporate managers often have an incentive to present earnings in the most favorable light, because stock prices, bonuses, and reputations depend on it. This doesn't mean all companies are dishonest, but it does mean the intelligent investor should always keep a critical eye. Per-share earnings may appear to be a clear guide, but like the surface of a calm sea, they can hide hidden currents. The intelligent investor does not accept them blindly. Instead, he looks deeper, averages over time, questions how the numbers were shaped, and demands proof of stability. By doing so, he avoids the trap of chasing illusions, and stays anchored to reality. In the chapters ahead, Graham will extend this discipline, showing how to apply analysis to both growth stocks and defensive investments. Chapter 13, A Comparison of 4 Listed Companies. In this chapter, Benjamin Graham shifts gears. Instead of discussing principles in theory, he presents a practical comparison, 4 different companies, each with its own story, strengths, and weaknesses. By examining them side by side, Graham shows how easily investors can be misled by surface numbers, and how an intelligent investor must dig deeper. The purpose of the comparison. Graham reminds us, financial statements are not to be taken at face value. Earnings, assets, and growth rates all need careful interpretation. By looking at 4 real companies, he demonstrates how reported figures can create very different impressions, depending on how you analyze them. The key lesson: companies are not always what they seem. Company A, the attractive growth story. The first company looks impressive on the surface. Its earnings per share are rising year after year, and Wall Street analysts sing its praises. At first glance, it seems like a perfect growth stock. But when Graham digs deeper, he notices that much of this growth comes from temporary conditions and accounting choices. The margins are thin, the balance sheet is stretched, and the business may be more fragile than it appears. The lesson: not all growth is sustainable growth. Company B, the conservative and steady firm. The second company does not dazzle. Its earnings rise slowly, perhaps even look boring compared to flashier rivals. But it has strong assets, conservative financing, and reliable dividends. Graham points out that while the market often overlooks such companies, they may represent safer, more rational choices for the defensive investor. Their strength lies not in rapid expansion, but in resilience. Company C, the glamorous performer. The third company shows spectacular earnings. Numbers that leap off the page. Investors rush in, driving its stock price sky high. But when examined carefully, Graham notes that much of this brilliance depends on one booming industry cycle. What happens when the cycle turns? Investors who bought at the peak, dazzled by growth, may find themselves with painful losses. Here Graham echoes one of his recurring warnings: beware of glamour stocks. They often shine brightly for a short while, before fading into disappointment. Company D, the troubled but misunderstood firm. Finally, Graham introduces a company whose earnings look weak and erratic. On the surface, most investors would dismiss it. But when examined more carefully, considering its assets, its balance sheet, and its long-term prospects, it might actually offer undervalued opportunity. This company illustrates the heart of Graham's philosophy: the market often misprices businesses, sometimes undervaluing those with hidden strengths. The central lesson. Through these comparisons, Graham delivers a simple but powerful truth. Do not trust first impressions. Reported earnings, growth rates, and Wall Street enthusiasm can all mislead. Only by examining a company's full financial record, its assets, its liabilities, its long-term earning power, can the intelligent investor decide whether a stock is truly safe and worthwhile. In life, as in investing, appearances can deceive. The shining star may burn out, the overlooked neighbor may endure, the troubled soul may carry hidden strength. By comparing these 4 companies, Graham teaches us not to chase the obvious story, but to look deeper. The intelligent investor does not follow glamour, nor fear difficulty, he searches for truth beneath the numbers. That, more than anything else, separates speculation from sound investment. Chapter 14, Stock Selection for the Defensive Investor. In this chapter, Benjamin Graham addresses a specific audience, the defensive investor. This is not the person who wants to constantly analyze markets, chase opportunities, or take on major risks. Instead, the defensive investor wants a portfolio that is simple, reliable, and largely worry-free. Graham's task here is to offer guidelines that make stock selection safe, systematic, and disciplined. The role of the defensive investor. Graham reminds us, the defensive investor's main goal is not to lose money. This investor is not seeking the thrill of outperformance but the comfort of long-term stability. To achieve this, Graham recommends focusing on large, financially strong, and conservatively managed companies. These businesses may not always be exciting, but they provide durability and protection against the unpredictable storms of the market. The criteria for stock selection. Here Graham introduces a set of filters, a checklist, if you will, for choosing stocks suitable for the defensive investor. The requirements are strict, but they are designed to minimize risk. 1. Adequate size of the enterprise. Only companies of sufficient scale should be considered. Size brings stability. Smaller companies, while sometimes attractive, are too vulnerable to economic shifts. 2. Strong financial condition. For industrial companies, Graham recommends a current ratio of at least 2 to 1, current assets double current liabilities, and long-term debt not exceeding net current assets. This ensures the business can weather downturns. 3. Earnings stability. The company should have shown positive earnings for at least the past 10 years. No interruptions. Consistency matters more than rapid growth. 4. Dividend record. A record of uninterrupted dividends for at least 20 years. Why? Because a firm that consistently shares profits with its owners proves both its reliability and its respect for shareholders. 5. Earnings growth. Over the last 10 years, earnings should have grown by at least 1/3. Not dazzling growth, but steady progress. 6. Moderate price-to-earnings ratio. Graham sets a rule: the current price should not exceed 15 times average earnings of the past 3 years. This protects the investor from overpaying. 7. Moderate price-to-assets ratio. The stock price should not exceed 1.5 times book value. However, Graham allows a compromise: if the P/E is low enough, the P/B ratio can be higher, as long as P/E times P/B does not exceed 22.5. The spirit of these rules. Notice the wisdom here. Graham's rules are not designed to help you find the next spectacular winner. Instead, they act as a shield. They eliminate risky enterprises, overpriced glamour stocks, and unstable businesses. What remains are companies that may appear dull to speculators, but to the intelligent investor, they offer peace of mind. The challenge of discipline. Graham also warns that many investors will struggle with patience. They may feel tempted to buy the latest hot stock, or ignore these strict rules in search of excitement. But excitement, Graham reminds us, belongs to the world of speculation. The intelligent investor seeks something different: endurance and safety. Closing reflection. The defensive investor must accept a truth: safety comes not from chasing the spectacular, but from honoring discipline. By choosing only companies that meet these demanding standards, large, stable, financially strong, fairly priced, he builds a portfolio that may not thrill him at every turn, but will protect and serve him across decades. In investing, as in life, true strength is often quiet. Chapter 15, Stock Selection for the Enterprising Investor. In the last chapter, Graham spoke to the defensive investor, the one who wants simplicity, safety, and minimal effort. Now, he addresses a different character: the enterprising investor. This investor is willing to devote time, energy, and judgment to the task of stock selection. He is not content with average results, he wants better than average returns. But, Graham warns, this desire must be pursued intelligently, never recklessly. Who is the enterprising investor? The enterprising investor is active. He studies, investigates, and makes careful choices. He must be ready to work harder than the defensive investor, because extra effort is the only way to earn extra reward. But here is the key: this work must not devolve into speculation. The intelligent enterprising investor does not gamble. He looks for value where others are not paying attention. 4 approaches for the enterprising investor. Graham lays out several strategies that can reward diligent effort. Each requires discipline, patience, and courage to go against the crowd. 1. Buying undervalued stocks, bargain issues. These are companies selling far below their intrinsic value, perhaps trading for less than their net working capital. They may be neglected, unfashionable, or temporarily troubled. But for the enterprising investor willing to dig deeper, they offer hidden opportunity. 2. Buying secondary companies. Not the big blue-chip giants that everyone follows. Instead, the investor looks at smaller or less glamorous firms. Many investors ignore them, which creates chances to buy at attractive prices. 3. Special situations and workouts. Here Graham points to unusual opportunities: mergers, reorganizations, liquidations, or corporate spin-offs. These events can temporarily distort prices, offering profits to those alert enough to act. 4. Buying growth stocks at reasonable prices. Growth is appealing, but dangerous if bought too dearly. The enterprising investor may pursue growth, but only when the price leaves room for safety. What to avoid? Graham cautions strongly: the enterprising investor must avoid 2 great temptations. First, avoid paying too much for fashionable companies, no matter how promising they seem. Second, avoid frequent trading or speculation. Impatience is the enemy of intelligent investing. The need for character. Being an enterprising investor is not just about analysis, it is also about temperament. It requires the courage to look wrong in the short term. It requires the patience to wait for value to be recognized. And above all, it requires the discipline to resist the herd, for the herd almost always overpays for hope and underprices reality. Closing reflection. The enterprising investor walks a harder path. He must dig where others glance, wait where others rush, and buy where others sell. His task is not easy, but when pursued with discipline, knowledge, and patience, it can yield rewards beyond the reach of the merely defensive. Still, remember this truth: effort alone does not guarantee success. Only when effort is joined with wisdom, humility, and steadfast adherence to principle does the enterprising investor earn his name, and his profit. Chapter 16: Convertible Issues and Warrants. In the world of investing, not every security is plain and simple. Beyond ordinary stocks and bonds, there exist hybrid creations: convertible bonds, convertible preferred shares, and stock warrants. These instruments often appear attractive, promising both safety and opportunity. But Benjamin Graham, ever the realist, warns us: beware of complexity disguised as opportunity. What are convertible issues? Convertible issues are securities, most often bonds or preferred stocks, that allow their holders to convert them into common shares at a predetermined price. On the surface, they seem appealing. You get the fixed income and relative safety of a bond. But you also hold the potential upside of a stock if the company prospers. It feels like having the best of both worlds. But here's Graham's warning. The buyer often overpays for this privilege. The conversion option is rarely free, it is usually priced into the security at a premium. And if the company does not perform well, the investor is left holding a bond or preferred share that pays less than comparable issues without the conversion feature. Stock warrants. Now, consider warrants. A stock warrant is essentially a long-term option to buy shares at a fixed price. Companies issue them as a sweetener to make other securities, such as bonds, more attractive. But for the ordinary investor, warrants are a dangerous lure. Why? Because they are highly speculative, often trading at prices that assume future growth far beyond what is likely. Graham stresses, warrants, much like lottery tickets, inspire dreams of outsized profits, but too often they end in disappointment. The problem with hybrids. The recurring problem with convertibles and warrants is this. They are designed to appeal more to the imagination of investors than to their reason. Investors often pay too much for the conversion privilege. The yield, or safety, is usually inferior compared to straight bonds. And when prices fall, both the stock and the convertible issue suffer, leaving little true protection. In short, the compromise between safety and growth usually ends up providing neither in full measure. Graham's verdict. So what is the intelligent investor to do? For the defensive investor, Graham is clear: avoid these instruments altogether. Stick to straightforward stocks and bonds. For the enterprising investor, there may occasionally be opportunities, when a convertible issue is undervalued compared to its underlying stock, or when a warrant trades far below its reasonable worth. But such chances are rare, and require sharp analysis. Closing reflection. The financial markets are full of ingenious inventions, crafted to tempt the investor with the promise of something extra safety, extra income, extra profit. But more often than not, these hybrids prove costly illusions. The intelligent investor learns this lesson well: when a security tries to be two things at once, it usually fails to be either. Choose instead clarity over complexity, substance over appearance, and simplicity over cleverness. For in investing, as in life, the simplest course is often the wisest. Chapter 17, for extremely instructive case histories. In this chapter, Benjamin Graham presents 4 detailed examples of real companies to illustrate the lessons he has been teaching throughout The Intelligent Investor. Each case demonstrates how investors can go wrong, or occasionally right, depending on how carefully they analyze a business, its balance sheet, and its true long-term prospects. 1. Penn Central Railroad. Penn Central was once the largest railroad in the United States. It declared bankruptcy in 1970, shocking the financial community. The company had issued large amounts of bonds and attracted investors with seemingly safe dividends. However, a closer look at the balance sheet would have revealed serious problems: heavy debt, poor management decisions, and declining revenues in the railroad industry. Lesson. Never assume that a large, prestigious company is safe. Even giants can collapse if their industries are weak and their finances are unsound. Underscore 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 underscore. 2. Ling Temcovat, Ltd. Corporation. LTV was a conglomerate that expanded aggressively during the 1960s. It bought many unrelated companies, steel, electronics, meatpacking, using borrowed money. Investors were lured by the growth story and the rapid expansion. But the company's earnings were unstable, and its debt burden became overwhelming. Eventually, its stock price collapsed. Lesson. Beware of conglomerates and companies that grow too fast by acquiring others. Rapid expansion often hides weak fundamentals. Underscore 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 underscore. 3. NVF Corporation and Sharon Steel. NVF was a small company that attempted to take over the much larger Sharon Steel. This was financed with huge amounts of debt, an early example of what would later be called a leveraged buyout, LBO. While it appeared like a bold business move, the financial structure was extremely risky. Shareholders and bondholders who believed in NVF's plans suffered heavy losses. Lesson. Do not be impressed by aggressive financial engineering. If an acquisition relies heavily on borrowed money, it endangers both the acquirer and its investors. 4. AAA Enterprises. AAA Enterprises was a company that looked very promising in the stock market. It was promoted as having great growth potential and became a popular story stock. But the company had weak earnings, no real competitive advantage, and was largely driven by hype. Eventually, the business failed, and investors who bought into the excitement lost heavily. Lesson: avoid speculative, story stocks. Exciting promises often conceal poor financial reality. Always insist on real earnings, strong assets, and proven business models. Graham's core point: the intelligent investor must be skeptical, disciplined, and grounded in facts. Market excitement, prestige, and promotion should never replace solid analysis of earnings, assets, and financial strength. Chapter 18, A Comparison of 8 Pairs of Companies. In this chapter, Benjamin Graham compares 8 pairs of companies, looking at how they were valued by the market versus their actual fundamentals. The goal is to show how investors often misjudge stocks, paying too much for glamour companies while overlooking solid but unexciting businesses. 1. Air Products versus Air Reduction. Air Products, a smaller, newer company, but with rapid growth in earnings. Air Reduction, a much larger, established business with consistent profits. In the stock market, Air Products was valued far more richly than Air Reduction, even though Air Reduction had more stability and assets. Lesson: the market often overpays for rapid growth and underprices stability. 2. American Home Products versus American Hospital Supply. American Home Products, conservative company, very strong balance sheet, cautious management. American Hospital Supply, growth-oriented, expanding quickly, but riskier. Investors rewarded the more aggressive company with higher valuations. Lesson: conservative management and financial safety may be overlooked, even though they provide long-term protection. 3. Emerson Electric versus Electric Boat, later General Dynamics. Emerson Electric, a manufacturing firm with steady earnings growth. Electric Boat, General Dynamics involved in defense, with earnings that were highly irregular, huge profits in wartime, but unstable otherwise. The market sometimes overvalued the defense contractor, ignoring the long-term risks of cyclicality. Lesson: consistency is often a safer bet than industries dependent on government contracts or cycles. 4. Emhart Corporation versus Adressograph Multigraph. Emhart, solid company in packaging machinery, financially sound. Adressograph Multigraph, exciting growth stock in office equipment, but overhyped. Eventually, Adressograph collapsed, while Emhart quietly prospered. Lesson: glamour fades, but financially sound companies endure. 5. McGraw-Hill versus Southwest Airlines, early years example. McGraw-Hill, established publishing company with stable income. Southwest, at the time Graham wrote, highly speculative airline business, dependent on fuel costs and regulations. Despite higher risk, investors often paid premium prices for the airline industry. Lesson: established, asset-rich companies may be safer than industries with unstable costs. 6. National General Insurance versus Aetna Insurance. National General, aggressive, fast-growing insurance firm that used risky strategies. Aetna, old, conservative insurer with strong reserves. The stock market gave National General a glamorous valuation, but the risks were very high. Lesson: in finance, conservative management usually outlasts speculative strategies. 7. National Presto versus National Dairy, later Kraftco. National Presto, specialized in defense contracts and home appliances, with volatile earnings. National Dairy, Kraftco food producer, steady and predictable business. Presto was sometimes priced more optimistically than Kraftco, despite much greater earnings risk. Lesson: earnings stability is more valuable than exciting but unpredictable profits. 8. Pair of retail companies, varies by edition. Graham compares a stable, conservative retailer with a more aggressive growth-oriented competitor. The more conservative company often proved to be a safer long-term investment, while the growth company was vulnerable to downturns. Lesson: in retail, and in general, slow and steady often beats aggressive expansion. Chapter 19, Shareholders and Management's Dividend Policy. Imagine yourself sitting with Benjamin Graham, as he guides you through one of the most debated topics in investing, the role of dividends. For centuries, dividends were considered the central reward of owning a stock. You bought shares, and the company rewarded you with a regular payment from its profits. It was tangible, real, and dependable. But as the 20th century moved forward, especially by the late 1960s, many companies began to change the rules. They held back earnings, reinvested heavily, and argued that this was better for shareholders in the long run. Graham asks us a simple but powerful question: are shareholders better off receiving steady dividends, or trusting management to reinvest profits on their behalf? The two sides of dividend policy. On one side, you have managements. They argue that by retaining profits, they can expand operations, fuel growth, and ultimately increase stock prices. They claim, "Trust us, we know how to use your money better than you do." On the other side, you have shareholders. They are the true owners of the business. They often prefer regular cash returns, because dividends provide certainty. They reduce reliance on stock price fluctuations and ensure that the company's profits are actually shared, not just promised. Graham's observations. 1. Dividends create discipline. When companies pay dividends, it forces management to use capital more efficiently. They cannot endlessly expand, experiment, or speculate with shareholders' money. 2. Retained earnings are not always used wisely. Graham studied many cases where profits were reinvested but did not lead to higher shareholder wealth. Sometimes money was wasted on poor acquisitions, unprofitable ventures, or expansions that failed. 3. Market prices react to dividends. Companies with steady, reliable dividend policies often commanded investor trust, and their stocks were less vulnerable to speculative swings. The problem of management control. A deeper issue lies beneath dividend policy, the relationship between shareholders and management. In theory, shareholders own the company. But in practice, management often acts as though they are the true owners. They decide how much profit is retained, how much is distributed, and how capital is allocated. Shareholders, especially small ones, usually have little influence. This raises an uncomfortable reality: many companies keep earnings not to benefit shareholders, but to give management more power, more projects, and more control. What Graham recommends. 1. A fair balance. Companies should not withhold dividends unnecessarily. Retention of earnings must be justified with clear evidence that reinvestment will benefit shareholders more than direct payments. 2. Shareholder rights. Shareholders should demand transparency. If management withholds dividends, they should explain why and show results. 3. Investor caution. As investors, we should favor companies that maintain sensible dividend policies. Over time, dividends provide a tangible return that stock prices alone cannot guarantee. The timeless principle. At the heart of this chapter, Graham delivers his principle. Dividends are the only true return shareholders receive directly from the business they own. Earnings may be retained, prices may fluctuate, but dividends put money in the owner's hands. Final reflection. So, when evaluating a company, Graham advises us not to be swayed by glamorous stories of reinvestment and future growth. Ask the simple question: does this company respect its owners enough to share the profits? If the answer is yes, you may be looking at a business with sound management and respect for shareholders. If the answer is no, be cautious, for history shows that retained earnings are not always the gift they are claimed to be. Chapter 20, Margin of Safety, as the central concept of investment. As the book comes to a close, Graham leans in and speaks with unmistakable clarity. If you remember nothing else from these pages, remember this: the margin of safety is the foundation of sound investing. What is the margin of safety? The margin of safety is simple in definition but profound in practice. It means, never buy an investment unless it offers a cushion, a buffer, a margin between what you pay and what you are likely to receive. It is protection against uncertainty, against human error, against the unpredictability of markets and businesses. Think of it this way: if a bridge is built to carry 10,000 pounds, engineers will not allow 10,000 pounds to cross it. They will allow maybe 6,000 pounds, maybe 7,000, but never the full limit. That extra capacity, that reserve, is the margin of safety. In investing, the same principle applies. If you estimate a stock is worth $100, you do not pay $100. You look for $70, maybe $65. That way, if your estimate is too optimistic, you are still protected. Why it matters. Graham reminds us, the future is uncertain. Businesses fail. Markets fluctuate. Analysts make mistakes. And even the best investors miscalculate. Without a margin of safety, every error, every misjudgment, every downturn can turn into disaster. But with it, you give yourself room to breathe. You allow for the inevitable imperfections of human judgment. The margin of safety, therefore, is not about greed. It is about prudence, discipline, and survival. Applications of the principle. 1. In bonds. A margin of safety means buying only bonds where the company has strong coverage of its interest payments, enough profits to pay debt comfortably, even in a recession. 2. In stocks. It means buying stocks when they are cheap relative to earnings, assets, or dividends. It means not paying fair value, but a price well below it. 3. In diversification. A portfolio diversified across industries and companies provides another kind of margin of safety, protection against one business or sector collapsing. The intelligent investor versus the speculator. The speculator ignores the margin of safety. He buys at prices that assume perfection, growth will continue, profits will expand, nothing will go wrong. But the intelligent investor does the opposite. He expects that things will go wrong, and he prepares for it. The margin of safety is his shield. Graham's final lesson. At this point, Graham pauses and delivers the essence of a lifetime's work. Confronted with uncertainty, the only rational course is to demand a margin of safety. Every rule in this book flows back to this one principle. Whether you are buying stocks, bonds, or entire businesses, the same truth applies: never risk everything on the hope that things will turn out exactly as planned. A principle beyond investing. And here lies Graham's brilliance: the margin of safety is not just an investment strategy. It is a philosophy for life. In engineering, it keeps bridges standing. In medicine, it keeps doses safe. In business, it guards against bankruptcy. In personal finance, it prevents ruin. The intelligent investor understands that no one can predict the future. But by insisting on a margin of safety, he ensures that whatever the future holds, he will endure. Closing words. As Graham closes his timeless work, he leaves us with a principle both simple and profound. The essence of investment management is the management of risks, not the management of returns. The margin of safety is always the secret of sound investment. With that, the intelligent investor comes to an end. But its central idea, this margin of safety, will remain as long as markets exist. It is not a trick, nor a formula. It is wisdom distilled into one unforgettable truth.